Congratulations on completing Level 3 of the crash course. Welcome to the final level. Welcome to Level 4, Lesson 1. In this lesson, you will learn about the different types of technical indicators that traders use on a daily basis. If you haven't been already taking notes, I highly suggest you do so in this level as things get a little bit tricky. Without further ado, let's get started. Before we begin, let's do a quick refresh. In the last level, you learned about the difference between technical indicators and market indicators. Technical indicators are pattern-based signals created by the price, volume, and/or some form of open interest on a stock. These indicators are plotted on the same graph as your candles and are used in technical analysis, as the name suggests. The great thing about technical indicators is that they offer visuals of historical data instead of numbers on your screen. Technical indicators support traders and investors in determining position entries or exits. Before you get overwhelmed by what's on your screen, let's go ahead and break down the most popular type of technical indicator, known as the volume-weighted average price, better known as the VWAP. The VWAP provides plotted data to draw an average price of a stock or security based on both the volume and the price of the stock. Most institutions use VWAP as a form of determining when to enter or exit a stock or security. In most cases, institutions will buy under the VWAP and sell above the VWAP. The important thing to note down when it comes to the VWAP is that it is used mainly for single-day charts. This means it is not ideal to use the VWAP on a daily time frame, weekly time frame, or a greater time frame. Rather, you should be using it on the 1-minute time frame, 5-minute time frame, 15-minute time frame, and so on, up to the point of the 1-day time frame. Another thing to note down with the VWAP is that it uses specific periods. These periods simply represent the calculation to be used. For example, if you use the VWAP 14, it will calculate the VWAP based on the last 14 candles. If you use the VWAP 20, it will use the information from the last 20 candles. Now, I know many of you may not be great at math, or if you are, you may not love math like me. I'm simply going to break down how VWAP is calculated. This is not something that you need to know, as your charting platform will do the calculation for you. Rather, this is just to give you an idea of how it should be calculated and how it is calculated. The VWAP is calculated by taking the sum of the candle close and multiplying it by the total candle volume. Of course, this is based on the period. If it is a VWAP 14, for example, it would take the sum of 14 candle closes and multiply it by the sum of 14 total candle volumes. This is then divided by the sum of the volume for that entire period. Let's have a look at an example. Let's say we are using VWAP 3. On candle number 1, the price was $10 at the close. The volume was 100,000. On the second candle, the price was $10.20 at the close, and the volume was 200,000. And finally, on the third candle, the close price was $10.40, and the volume was 400,000. After doing the calculation, we end up with 1,000,000, 2,040,000, and 4,160,000. After calculating the sum of these three values, we would then divide it by the sum of the volume overall. That would be 100,000 plus 200,000 plus 400,000, amounting to 700,000. This means that at the third candle, the VWAP value would be $10.28, and you would see that plotted on your chart. Let me go ahead and show you how to add the VWAP to your chart and how it looks plotted on a regular chart. Depending on your charting platform, the steps taken to add the VWAP to your chart may be different. In this case, I am using tradingview.com. So let's have a look at how we can add the VWAP. First, we would start by pressing the Indicators button at the top left of your chart. Once we press that, we can go ahead and search VWAP. This would show under Technicals as Volume Weighted Average Price. Once we click on that, our VWAP would be added. Let's go ahead and remove some settings as TradingView adds some extra settings to the VWAP. Most charting platforms do not do this. We can go ahead and click on the Settings tool here, go to Style, remove the upper band, lower band, and the band's fill. I'm going to go ahead and increase the thickness of the line and make it orange because I like that color. Obviously, you can change the settings to your preference. Once we're happy with our settings, we can go ahead and press the OK button. This would display our VWAP. So let's break down how the VWAP would actually be played by an institution, for example. Now that we have the VWAP plotted on our chart, this is where I highly recommend you start taking notes, as I will go into some detail you may forget later on. As I mentioned before, institutions typically enter a stock when the price is below the VWAP and exit when the price is above the VWAP. Looking at it from an institutional perspective, we would buy in this region here as the price is below the VWAP, and we would exit in this region here as the price is above the VWAP. This leads to the first misconception when it comes to the VWAP. The second misconception is as follows. As we can see, when the price is below the VWAP, there isn't much volatility or price change. When the price is above the VWAP, there is. Many traders assume that when the price is above the VWAP, it is a great time to buy, as we can see volatility and significant price change. This is not always the case, which is why we come to misconception number 2. Let me go ahead and show you how exactly you should use the VWAP in order to increase the accuracy of your trades in the future. VWAP, as I mentioned, stands for Volume Weighted Average Price. Do you notice the key term? Volume. If volume is integrated into the VWAP, why would we not use the volume indicator or the volume histograms to support our theories? In fact, if it is used in the calculation, wouldn't it be better to use the volume along with the VWAP? Many traders do not do this, which is why most traders are unsuccessful. Let me go ahead and show you how you can use the volume to confirm your theories and place more accurate trades. As I mentioned in an earlier lesson, using the support and resistance, we can use volume with the VWAP as well. As you can see, as we approach the VWAP, we see the volume increasing. This is a good indication that we may likely break above the VWAP. This is not the time to enter, but it is a good indicator. This can be used the opposite way as well, but let's have a look here. The volume increased, we broke above and continued running. Fantastic. If we go ahead and look at the inverse, we can apply the same rule. Let's say we're moving down towards the VWAP as we are above the VWAP. Again, we would look at the volume. If the volume is increasing as we approach the VWAP, we can assume that we will likely break below the VWAP. And in this case, we do exactly that. This alone is not, unfortunately, satisfactory enough for most successful traders. The volume increasing going towards the VWAP is not enough to place a trade. Let's have a look at an example why. The two key terms to note down, and this is important, are the bearish trap or bear trap and bullish trap or bull trap. The names are very straightforward. A bearish trap traps the bears or the people who are expecting the price to move down. And a bullish trap traps the bulls, the people who are expecting the price to move up. So how exactly do we use VWAP and volume to identify a bearish trap or a bullish trap? Well, let's have a look. In this example, we can see a bearish trap because the price moved below the VWAP and suddenly broke back above, running really high. Somebody betting on the price going down would lose significantly in a situation like this. But how do we identify a bear trap? Well, let's have a look. The price moved down below the VWAP. However, as soon as we broke below the VWAP, the price began trading sideways very close to the VWAP. This, again, is not enough. We now need to look at the volume to ensure that this is likely a bear trap. We can see that after breaking below the VWAP, the volume flatlined or pretty much died. Over here we have volume, and over here we have volume. In both cases, we're above the VWAP. However, when we're below, we have almost no volume. This is how you identify a bearish trap. When the price does not really change, does not make sudden movements, is below the VWAP very slightly, and the volume almost becomes non-existent once we break below the VWAP. You can see the example play out here. This trapped the bears and the price moved up. But how does a bull trap work? The bull trap is the same. Let's say we broke above the VWAP, and this is misconception number 2. Let's go ahead and add over here. Wrong. In fact, you would lose on this trade as we now have a bullish trap. Let's go ahead and edit that. And we now have a bullish trap. Again, the price goes above the VWAP, remains very close to it, and does not make any sudden changes. The volume also decreases. This is a good indication of a bullish trap. So if you're looking to buy the stock, it would probably be a better idea not to. The next type of technical indicator is known as the Relative Strength Index, better known as the RSI. The RSI is a momentum indicator and evaluates whether a stock is oversold or overbought over a certain time frame. The RSI is a great indicator for determining reversals of trends by using 2 different strategies. The first strategy, which in my opinion is a weaker strategy, is known as the oversold overbought method. The stronger strategy and more reliable strategy are known as divergences on the RSI. I will explain these in my example. When looking at the RSI, if the line is below 30%, this is an indication of an oversold stock. This implies that there should be a reversal upwards. If the RSI is above 70%, this indicates that the stock is overbought and signals a reversal downwards. Let's have a look at an example using both strategies. As I mentioned earlier, a stronger and more reliable strategy when using the RSI is by identifying divergences. The first step to identifying divergences is to determine if you want to go long on a position or if you would like to go short on a position. If you would like to go long on a position, you must keep an eye on the bottom of the candlestick charts and the bottoms of the RSI. So let's have a look at this chart. Over here, we have identified one bottom, or one low, and over here, we have identified the second low or bottom. We can see that the first low is lower than the second low. So we have identified a higher low. On the RSI, however, we see the opposite to be true, as we have a low over here, but we have a lower low over here. This is a divergence, as what is shown on the candlestick chart is the opposite on the RSI. This is a good indication of a reversal upwards as we are looking for going long. So how do we use RSI to determine or identify a move downwards? In this particular case, we would be looking at the top of the candlestick patterns and the tops of the RSI. Looking at this example here, we can identify one top or one high. We can identify our second over here. Notice how we have a higher high in this region here. Looking at the RSI, on the other hand, the opposite seems to be true, as we have a high over here, and then we have a lower high over here. This again is a divergence, indicating a move downwards, and we get exactly that, following the divergence. Adding the RSI indicator to your chart is done the exact same way as adding the VWAP indicator. Once you have gone ahead and done so, it should look something like this. Please make a note that the RSI added is typically the RSI 14, which means that the RSI is calculated based on the previous 14 candles. Now that we have the RSI on our chart, let's talk about the first strategy, being the overbought, oversold strategy. In most cases, traders will typically wait for the RSI to fall under 30%. Once it does so, they will go ahead and add a position. Once the RSI is over 70%, they will go ahead and exit the position. As I mentioned before, this is a weaker strategy. Let me explain why. We can see that over here, the RSI is below 30%, which means we would add our position. Over here, however, we see that the RSI is over 70%, implying that it is overbought and that we should sell our position. However, in this case, the stock price kept moving up despite the RSI being overbought. This is why it is a weak strategy and not a strong strategy. This strategy is not incorrect, but there is a better way of doing this. So let's have a look at the divergence strategy. The next type of technical indicator is known as the moving average convergence divergence, better known and almost always known as the MACD. The MACD is a trend following momentum indicator. What the MACD does is it evaluates the relationship between two moving average lines. If you don't know what the moving average is, I'll explain it in the next lesson. What's important to note down for the time being is that the MACD is a crossover signal indicator. This crossover signal indicator uses two different moving average lines, the first being the exponential moving average, or EMA 26, meaning that we are looking at the previous 26 candles, as well as the EMA 12. When looking at the MACD line is the EMA 12, and the signal line is the EMA 26. This may sound confusing, but I'll make it very, very simple in this next example. Let's have a look at it. Adding the MACD technical indicator is done the same way as adding the RSI and the VWAP. Once you have gone ahead and done so, you will see something that looks like this. I personally do not like the presence of the histogram on the MACD indicator, so I will go ahead and remove it. This looks a lot simpler. What I will then do is add a horizontal line at the 0 mark on the MACD. You may be wondering why I'm doing that, and I'll explain that in a few moments. For now, let's talk about how the MACD works. As I mentioned before, the MACD is a crossover signal indicator, meaning that we are looking for a crossover to signal a buy or a sell of a stock. In my case, my MACD line is green and my signal line is red. When using the MACD, we are looking for the MACD line to cross over the signal line in order to go long or take a long position. The opposite would be true when taking a short position. So let's use the simple example. We have a crossover right in this region, indicating a buy signal. If we went ahead and added it in this region, we can see that the price does not really move for quite a while. This is because the crossover happened below the 0 mark, indicating a weak momentum or weak uptrend. Ideally, when you're going long or taking a long position, we would like for the crossover to happen above the 0 mark. Notice how when the MACD line and the signal line are above my 0 line, we see greater price movements. This is not a coincidence. When going short on a position, however, we would like the opposite to be true. Notice how in this case, the MACD line crossed under the signal line, while both lines are below the 0 mark. And notice how there is a strong price movement downwards. This indicates a strong trend downwards. This is the simplest way to use the MACD. In fact, this is the only way I would suggest you use the MACD. If there are any other ways, there is a chance that they are a weak strategy. This is the strongest strategy to use when using the MACD. The next type of technical indicator is known as the Ichimoku clouds, and they can be added the same way as the MACD, RSI, and the VWAP. If you find it difficult to conceptualize difficult trends or difficult indicators, I highly suggest you skip over this part of the lesson. You can still be a successful trader not using the Ichimoku clouds. If you would like to take the challenge on, please stick around and I'll explain exactly what the Ichimoku clouds are. Once you have added the Ichimoku clouds, you may be overwhelmed by the number of lines present on your chart. Do not be alarmed by this, as each line is used for a different strategy. Let's go ahead and break down each of these lines. The first line is known as the conversion line. The conversion line is used for short-term trends, meaning that it is applicable to scalp traders. As a scalp trader, you are looking to enter and exit a position within a few seconds or a few minutes, so this conversion line would benefit you. But how do we go about using this conversion line? First, you would wait for a green candle to both open and close above the line. That would be your entry signal. Once you enter, you can exit whenever you are happy with your profits or if you would like to manage your risk and not take as big of a loss. The next line is known as the baseline. This line is used for more medium trends, meaning that you are looking to enter and exit a trade within 20 minutes to 60 minutes. The baseline is used the same way as the conversion line. You would look for a green candle to both open and close above it. That would be your entry signal. You would choose to exit the trade whenever you feel comfortable with your profits, or if the candles touch the baseline again. The next line is known as the lagging span. This is used very differently than the baseline or the conversion line. The way the lagging span is used is by identifying if the candles are either below or above the lagging span. If the candles are below the lagging span, that is a good indication of a move upwards. If the candles are above the lagging span, that is a good indication of a move downwards. If we look at this example here, we can see that when the candles are below the lagging span line, the price continues to move upwards. When the candles finally are above the lagging span line, the price moves downwards. The same applies here, 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 and so on. The final and most important part of the Ichimoku cloud indicator is surrounding the two lines known as the leading span A and leading span B lines. Both of these lines are filled with clouds, hence the term Ichimoku clouds. But how do we go about reading this indicator, or this part of the indicator? If the price is above the clouds, that is a good indication of a strong upwards trend. The more time we spend above the clouds, the stronger the uptrend is. The more time we spend below the clouds, the stronger the downtrend is. One thing to make note of is that it is important to not buy nor sell if the price is in the clouds. Another thing to note down: when the leading span A line is far from the leading span B line, or if the cloud is quite big or wide, that is a good indication of a strong support or resistance, meaning that it would be difficult to break either above that cloud or below that cloud. If the line or clouds do get thin, it is quite easy to break below. Notice how over here we actually break below quite easily, and over here we break above quite easily. Let me go back to why you shouldn't sell if the price is in the cloud region. As we make our way up, we enter into the cloud. If you were to sell here, you would be greatly mistaken as the price continues to run up. This is because there is a significant gap between the leading span A and leading span B lines. Overall, if you're looking to play with the Ichimoku clouds, I would highly suggest adding the leading span A, leading span B, and lagging span lines to identify when you should exit. The final technical indicator, and possibly one of the most popular technical indicators, are known as Bollinger Bands. Bollinger Bands are a technical analysis tool. These tools evaluate and provide overbought and oversold signals. But what is this tool comprised of? The first thing it is comprised of is a simple moving average, or SMA, of 20, meaning that it is looking at the previous 20 candles. In addition, it has a plus or minus standard deviation from the SMA 20. I will not get into the calculation or break down why this is so, as it is very, very complicated. Instead, let me show you an example and explain how you can use the Bollinger Bands to your benefit. The Bollinger Bands indicator can be added the same way as the RSI, VWAP, MACD, and Ichimoku clouds. Once you have gone ahead and added the Bollinger Bands, you should see something that looks like this. Let's go ahead and break down what each of these lines mean. The middle line in the Bollinger Bands is the simple moving average of 20, or the SMA 20. The upper band is the plus standard deviation, and the lower band is the minus standard deviation. But how do you go about using the Bollinger Bands to your benefit? The answer is quite simple. When the standard deviations come close to the SMA of 20 or the SMA 20, this implies a tightening of the Bollinger Bands. Notice how over here we are tightening as the standard deviations are not far off. What this does is it indicates a great movement incoming. The only problem is Bollinger Bands do not tell you if it is a move upwards or a move downwards. It simply tells you that there is a move coming. So what do you do about that? And how do you know which direction you should pick? That is where your other indicators and your trend lines come in handy, as they can support you in determining a move upwards or a move downwards. As the Bollinger Bands tightened, we saw a great upwards movement, followed by a spread of the standard deviations. Once again, the Bollinger Bands begin to tighten, followed by a great move downwards, and then a great move upwards. Over here, we can see that the Bollinger Bands are tightening once again. Unfortunately, I cannot predict the future, so I would not know if this is going to move up or down, as we have not approached that day yet. But what I can tell you is that there will be a great move coming soon. And that concludes this lesson.